Most traders are staring at the exact same chart as you, yet somehow they keep getting in at the worst possible moments. So what are they missing that others clearly see? It's not the chart, it's not the indicators, it's the way they interpret what's actually happening underneath the surface. And once you see it, you can't unsee it. Here's the reality. Price alone is misleading. It shows you what happened, but it hides why it happened. And that why is exactly where the real edge lives. If you don't understand that, you're essentially trading blind while thinking you're informed. That's why some traders consistently find high probability buy and sell zones while others keep chasing the market at the wrong time. This is where volume changes everything, because while everyone else is watching price, professionals are reading the story behind it. And once you learn how to combine price with volume, the market starts to make a lot more sense. Suddenly, those confusing moves become predictable. Those random reversals, not so random anymore. In this breakdown, we're going deep into exactly how that works, step by step, so you can start identifying high probability buy and sell zones with far more clarity and confidence. Step 1. Understanding the relationship between price and volume. This is where everything begins, because if you misunderstand this, nothing else will click properly. Price by itself is incomplete. It's just the final result. Volume is what explains that result. Think of it like this. Price is the outcome, volume is the cause. Without understanding the cause, you're only seeing half the picture. Picture a stock steadily moving upward. Candle after candle, it climbs higher. Now, if volume is also increasing with each move, that tells you something critical. Buyers are fully committed. Demand is real. There's strength behind the move. The market has genuine momentum. But now flip the scenario. Price is still going up, but volume starts shrinking with every new candle. At first glance, everything still looks bullish, but underneath, something is changing. Buyers are losing strength. The move is no longer driven by strong demand, it's just running on leftover momentum. And this is exactly where things start to get dangerous. Because while retail traders are still buying into the move, large institutions often begin pulling back. They stop aggressively buying, and eventually that imbalance leads to a sharp reversal. The trend didn't just fail, it was weakening long before it broke. The same logic applies in reverse. If the market is dropping and volume keeps increasing, sellers are aggressive. There's conviction behind the move. But if price keeps falling while volume fades out, selling pressure is drying up. And that's often when smart money quietly steps in to accumulate positions right before the market turns. This is why price alone will always leave you guessing. Volume tells you whether the move actually has strength behind it or if it's just an illusion. Step 2. The effort versus result concept. This is one of the most powerful mental models professional traders use, and once you understand it, you'll start seeing the market very differently. In simple terms, volume represents effort, price movement represents the result, and the relationship between those two reveals what's really happening. If effort and result match, everything is normal. For example, volume expands significantly and price moves strongly in the same direction. That means buyers or sellers are successfully pushing the market. The trend is healthy. But now flip the scenario. Volume spikes massively, but price barely moves. That's a huge amount of effort with almost no result. Something is off. And in many cases, this signals distribution. Institutions are quietly selling into retail demand. While the market looks strong on the surface, the underlying strength is actually fading. Now look at the opposite situation. Volume is extremely high, but price refuses to move lower. Every drop gets bought instantly. That tells you something powerful. There's strong buying absorbing all that selling pressure. And this is often how major reversals begin. So always pause and ask yourself, does the effort match the result? If it does, the trend likely continues. If it doesn't, the market could be preparing for a significant shift. Step 3. Identifying high probability buy zones. Now we start putting this into action. The first pattern is stopping volume. Imagine a market that's been falling for days. Every candle is bearish. Fear is everywhere. Traders are panic selling. Then suddenly, volume explodes. Price drops during the session, but by the close, it recovers strongly. That's not random. That's a signal. Despite heavy selling, price couldn't stay down, which means someone absorbed all that supply. And that someone is often smart money stepping in. This is called stopping volume. It doesn't mean you blindly buy immediately, but it tells you the downtrend may be running out of strength. Next comes the spring or false breakdown. Price breaks below a key support level. Retail traders panic and sell. It feels like the market is collapsing. But then, almost unexpectedly, price snaps back above support and volume is elevated. What just happened? Liquidity was collected below that level. Weak hands exited, strong hands entered, and this often forms a high probability buy zone. Then comes confirmation. If price breaks out and volume is significantly above average, the breakout is far more likely to succeed. But if price breaks out without strong volume, it's often a trap, a fake move that quickly reverses. Step 4. Identifying high probability sell zones. Now we flip the lens. One of the most important patterns here is the buying climax. Picture a market that's been rallying hard. Optimism is everywhere. News is positive. Social media is flooded with buy calls. Everyone feels confident. Then suddenly, volume surges massively. Price shoots up. But by the end of the session, the candle leaves a long upper wick. That's a warning sign. It means heavy selling occurred at higher prices. Retail traders were buying aggressively, while institutions were quietly taking profits. This is a buying climax, and it often marks the beginning of market weakness. Another key signal is the upthrust. Price breaks above resistance. Traders rush in expecting a breakout, but then the candle closes back below resistance and volume is extremely high. That tells you the breakout failed. Liquidity was collected, buyers got trapped, and the market may now move lower. This is a classic high-probability sell zone. Step 5. Volume divergence. This is one of the most powerful tools, but only if used correctly. If price keeps making higher highs while volume steadily declines, the uptrend is losing strength, momentum is fading, fewer participants are involved, and the probability of a reversal increases. Now consider the opposite. Price keeps making lower lows, but volume is decreasing. Sellers are becoming exhausted, the pressure is fading, and this is often where the market begins forming a bottom. But here's the key. Volume divergence should never be used in isolation. When combined with support, resistance, and overall structure, it becomes far more reliable. Let's bring this into a real-world scenario. Imagine a stock approaching major support at $100. Price keeps falling until it hits that level. Then suddenly, volume spikes to 3 times its normal level. During the session, price drops to $96, but by the close, it recovers and finishes above $101. If you only looked at price, you'd miss the story, but volume reveals the truth. Strong buying stepped in aggressively. The next day, price breaks above $103 and volume expands again. That's where a high-probability buy zone begins to form. Now flip the situation. A stock approaches major resistance at $500. Price breaks above it, reaching $510. Volume is extremely high, but by the close, price falls back to $495. That tells you everything. Buyers were trapped. Institutions sold heavily into that move, and that area often becomes a high-probability sell zone. Now here's where most traders go wrong. They rely only on support and resistance lines, but not every level matters. Not every line holds weight. What separates strong levels from weak ones is volume. If a level attracts unusually high volume, it's significant, it matters. But if there's no volume behind it, it can fail easily. So before you act, always ask yourself 3 questions. Did unusual volume appear at this level? Did price respond the way it should based on that volume? And does the overall structure support the idea? If all 3 align, you're no longer guessing, you're reading the market with clarity. And that brings everything together. High probability buy and sell zones don't come from indicators. They come from understanding how price and volume work together.
When you can recognize where demand is truly strong, where supply is taking control, where effort no longer matches the result, and where smart money is quietly revealing itself through volume, you stop reacting emotionally. You start making decisions based on how the market is actually behaving. Always remember this: price shows you direction, volume shows you conviction, and when both align, that's where the highest probability opportunities begin to reveal themselves. If this made you see the market differently, drop a "ready" in the comments. Let's see who's actually serious about leveling up. And if this gave you real value, hit like, because the next level is only for those who recognize it.